To Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome back to Insurance Matchmaking. It is cold weather, winter. We'll see if we'll have another snow, depending on when this show airs. I think this one's going to air a little bit later. Got one already in the bag, so I'm not going to talk about dates too much here because they might be passed before you hear this episode. But I did want to recap on one thing. I'm not going to talk much about Medicare today, but one thing I just kind of wanted to remind folks, a lot of people are just now getting those refills on those prescriptions that they're finding out they're more expensive because they hadn't paid the deductible yet this year, or sometimes with those expensive drugs, if they didn't review their drug plan in the fall, that drug's no longer covered by the plan they have. It's very imperative if you know someone that's happened to, have them get a hold of us, or another local agent. I've always preached that. Don't call an 800 number. Find a local agent that handles Medicare if you have issues with that, and that's why I say call our office. And hopefully, if you're listening to this, that's who you would call anyway. But give them our name, refer them to come to. It doesn't cost anything for us to check and see if we might be able to help them. We do still have the disaster special enrollment, SEP as we call them, because of Hurricane Helain. So if someone who didn't make a change during the annual election period last fall does have another chance to possibly change their plan. And like I say possibly. I'm not going to guarantee anything, because if it doesn't happen, then I'm in trouble. But we will definitely try to see if we can get somebody switched if they don't, their plan is not working right for them. So there's a couple of ways that we can change people's plans here in the first part of the year. So don't wait, say, I'm just stuck till next year. Check with us. Doesn't cost anything to them for us to see if we can help. So whether it's you or someone if you hear them complaining about their Part D prescriptions, have them give us a call. If it's, their regular insurance or just a cost of a certain prescription, we probably can't help them. But if it's related to Medicare, I would say we probably can. So I just wanted to cover that. Like I said, I'm not going to talk a lot about Medicare today, but I'm going to talk about everybody's favorite subject, life insurance. Everybody loves to talk about life insurance, right? But I realized if something come up this week, and I was like, that's something I need to maybe focus a little bit more on. And I know it's a subject that most people don't want to talk about, but I kind of want to address, because sometimes people aren't really aware of that there are different forms of life insurance, and they cost different, and they have different uses. There's a lot of things that you can put to use. You've maybe seen, I hadn't really participate in it, but I'm not against it, is what they call the infinite banking system. And what that does is you take a whole life insurance plan and basically kind of like heavily fund it up front. And so you make a big, you pay the annual premium. So you're putting several $1,000s in place in that life insurance policy. And then what you do is you take out loans again from that policy. You still have the life insurance policy. It's still earning what it would earn, the dividends or whatever. I'm probably butchering this because that's not really my specialty. But the value of that whole life plan still grows. It could reduce the death benefit because you've taken a loan out from it, but it doesn't cancel the insurance. And so that's a way some people can cut down on some of their expenses. But one of the things that a lot of people don't realize about life insurance, and that's why this kind of came up in conversation here recently, is your beneficiary of your life insurance doesn't pay taxes on that. So if you have $100,000, and just using an example here, you have $100,000 life insurance, and you name your oldest son or only son as the beneficiary of that life insurance policy, because you want to leave something behind. You want to leave a legacy, as they say. When you pass away and that son files that claim, they get that money paid. Now, it may be that you're leaving as a legacy, or you may be doing like what we call the final expense plans. Again, the money goes to the beneficiary. Usually it's earmarked to pay for funeral costs or cover any lingering debts. And so that comes in very handy. Unfortunately, I had a client, had her daughter notified me this last week that her mom had passed. I wasn't aware of that, and it kind of took me by surprise. I did talk to her last fall during the annual election period for Medicare, and just going over whether she needed to make any changes, and everything's fine. And I'm not sure, how she passed, but and it's one of those. She's been a long-time client. I met these people when I was in my very first office in Kingston. So she was a long-time client. Her husband had passed away several years ago, so she depended a lot on my help. And it was, but I reached out and said, hey, do you need any help filing the claim on the life insurance? And she said, no, the funeral home took care of that. We needed to cancel another policy, and that broker support was about useless. I did end up having to get her some other information so that she could cancel the other plan that her mother had. And it was just a matter of just making sure they weren't going to be billing that every month. It wasn't a huge plan, and if one of those, it would have just gone away if she closed out the bank account. So it wasn't going to be a big deal on that one. But so she was able to get that claim in for that life insurance, and that helped pay the funeral expenses. I don't know if it covered them all. I don't know how much they spent, but that comes in really handy because if you haven't priced funeral costs lately, you might want to look into that and then look into a final expense life insurance policy. That's probably what I probably do more of than anything, is the final expense, and mainly because I'm usually dealing with the Medicare folks. And so I'm dealing with people who are in their 60s and 70s. And so they start thinking about those costs, and they don't want to be a burden on their family for those costs. So they look into do a life insurance policy. And I've gotten some pushback also from clients who are like, well, I'll just save that $10,000. And it's like, yeah, you can do that, but you won't. The other thing is, how much are you going to put in the bank each month to save that $10,000? And the thing is, if you're paying $50 a month for a $10,000 life insurance policy, again, hypothetical amount, keep round numbers, keep it simple. Say you're paying $50 a month to have a $10,000 life insurance policy. Well, that's $600 a year. So in 3 years, you would have spent $2,400, and you'd have $10,000 to, if you pass away in a year and a half, you'd have $10,000 to cover. And if you can't afford the $50 a month, you're not going to save $10,000. So you come out ahead. Those policies are a little bit higher. It's one of the reasons they do them as whole life policies, because they're generally going to pay out, because they know it. People are getting those policies. That's why they call them final expense. They're there designed to pay for those funeral expenses. There's going to be a claim on that policy. There are some that are guaranteed issue, or you have what's called graded. They're going to be more expensive because the insurance company is figuring you're going to cash in those benefits sooner than if you were in better health. So they know they're going to pay out sooner, so they're going to charge you more up front. But they're very inexpensive, and you don't have to be 60 to get one. You can get one when you're, most of them are on the final expense plans usually they're like 45 and up. They really are designed for the older generation for those final expenses. And actually, I think some companies will let you get those plans at a younger age, but the ones that have like the guaranteed issue, it's like that's the 45 is like the youngest age they can get the guaranteed issue, because if you're getting guaranteed issue, you're in poor health. You've had cancer, you've had a recent heart attack, you have you're not classified as terminal, but you probably are not going to live more. You're not expected to live more than 5 to 10 years based on your health conditions. So they're going to charge you more, and they're not going to pay out anything other than accidental death in the first couple of years because of that. So they're taking that risk on, but they're going to charge you a little more up front. I was going somewhere with this. If you're younger, you can get it at a low rate. Oh, that was one. Some of the plans have what they call 7-pay or 10-pay. And what those mean is that's how long you pay for the insurance. It is a whole life policy, but it can be paid up in 7 or 10 years. So you could come up, you're paying, especially if you get it when you're younger, when you're still actively working, and it's not going to be a burden on you expense-wise, you put that money into that life insurance policy so you know it's there regardless of whatever else happens on your life insurance. The other thing is a lot of times people think about and I have to remind myself of this, is when you have two couples on that fixed income living on Social Security, when one of them dies, now a lot of times, because it's usually the man that dies first, and it's usually the man who was the main breadwinner whose Social Security is more, that surviving spouse can take that person's Social Security and have a little bit of raise on their Social Security, but there's still only going to be one spouse's worth of income. And your household expenses, most of your household expenses don't get cut in half because your spouse dies. Your food costs may go down, but the heat, the electricity, the taxes, all of those still continue. And the other thing is, a lot of people will look at that, they're going to, when they pass, we're just going to sell the house and get something smaller or whatever. Well, the problem is sometimes it takes a little while to sell a house. Or if you've got to have that money right away, you have to take the first offer. That may not be a very good offer. Whereas if you have a final expense life insurance policy, and maybe you don't need it for the burial. Maybe you've already covered the burial expenses. Maybe you just want a $5,000 policy to cover those household expenses for a couple months until the surviving spouse can sell the home. So there's other uses for a final expense policy, and not just for paying for the funeral. So that's a biggie there. The other is on these, most of the companies that offer final expense, or a lot of them that do, or ones that I have, also will offer children. In fact, I got reminded myself this morning that I realized I was going to talk about the life insurance and realize that I haven't done anything about my youngest grandson's life insurance, and he's 11 months old now. So I need to get going on that because I do have life insurance on all my grandchildren. So, I'm practicing what I preach. I'm not just saying, you should get life insurance on your children or grandchildren, and I'm not doing it on my own. And believe me, it's not a matter to get rich, but it's a matter of getting your children insured when they're insurable. I had a previous coworker whose grandson developed diabetes at 13, 14 years old, type 1 diabetes. Well, he's uninsurable then. He may be able to get something later, when he maintains it, but it put them in a position where that wouldn't work. So anyway, as we coming up on the break here, and when I come back after the break, we'll talk about some other types of life insurance.
This is David Price, your Twin Lakes Business Solutions Consultant. Are you or someone you know planning for college this year? Twin Lakes is proud to partner with the Foundation for Rural Service to provide graduating seniors in our service area scholarship opportunities to continue their education. FRS scholarships empower rural students to enhance their communities with valuable skills and experience. You may apply at twinlakes.net, but hurry, the application deadline is February 14th. Prepare for your future today.
Join Upper Cumberland Habitat for Humanity for their Race to Build Hope 5K Run Walk, Saturday, March 29th at 8 a.m. at the Livingston Central Park. The race is supporting Upper Cumberland Habitat for Humanity's mission to build affordable homes and strengthen communities. So lace up and join the fun Saturday, March 29th at 8 a.m. at Livingston Central Park for Upper Cumberland Habitat for Humanity's Race to Build Hope 5K Run Walk. To register, visit uchabitat.org.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, welcome back from the break there. Want to touch back a little bit what I started in the first segment about children's insurance. You're not getting it to, it's not like you're getting insurance and leaving them a legacy. It's not, to help your pocket so much in that you can pay off the house, but if you lose a child, and I have, so I do know kind of how that works, you may not be ready to go back to work. You may need to take more time, and I believe you can use the FMLA leave policy with losing a child, but that doesn't get you paid during that time. Your employer has to give you the time off, but it doesn't mean they have to pay you. So some people go back to work before they're really ready, because they have to earn a living and keep the roof over the head for the rest of the family. So that's one of those things that you can hedge off a little bit with having a policy on your child. And as I mentioned in the first segment, of guaranteeing that insurability. Getting a child a policy, when they become an adult, they have the opportunity to own that policy. And most of the time, they're going to be a whole life plan that's going to have some cash value. That's something you can do to kind of help them out for their future. The other thing I didn't talk about, term life. When I'm talking about mainly the final expense in that first segment. But a lot of, and there's people out there that preach that, buy term, invest the difference, don't get whole life. I don't subscribe to that philosophy. They both have their purposes, and maybe you shouldn't have just whole life. But yes, you can get term life for a lot less money. The problem with most term life plans are you have that policy for 10, 20, 30 years. You pay that premium religiously, and then at the end of that term, that 10 or 20 or 30 years, congratulations, you didn't die. Thank you for paying us your money. I mean, that's how insurance works. You're exchanging the risk. Now, there are plans out there that also have what we call return of premium. They're going to be, higher per month than your standard term. But at the end of that term, you get those premiums back. So, or a good chunk of them. It's not 100% of what you paid in, but it's probably close to about 90%. So you do basically get your money back. There are some expenses, fees on the insurance, but you get the majority of it back. And I say the majority, close probably around 90% of what you paid in, you're going to get back if you do a return of premium. So it will cost you more than your typical term, and most times people are looking, they want the lowest monthly premium. So that's great. And term life works great. Say you're a young couple, maybe just bought a house, maybe have 1 or 2 kids, and so you want to make sure that for some reason you do not come home from work because of a heart attack, a car wreck, something happens, and your income is now gone. Your family doesn't have that income anymore, and that goes for both husband, or wife. It doesn't have to be always a husband, even though that's what we think most of the time. And a lot of times, you have some husbands that, hey, the wife is fortunate to be able to be that stay-at-home mom and shuttle the kids to school and all that they don't need life insurance because they're not the one bringing the income in. If your spouse is the stay-at-home parent and taking care of the kids, getting them to school and all that, or even homeschooling, who's going to do it when they pass? You're going to have to hire somebody. You maybe need to have somebody that's there to get them to school in the morning and be there when they first come home because, or now you got to pay for daycare. There's a lot of other expenses that could come up. So it really is important for both spouses to have some life insurance. Now, you may still have more on the working spouse because they are the main breadwinner. Both spouses need life insurance. And one of the reasons term life works great for these young couples or young parents is it is the least expensive of life insurance because it does have a finite period. It does end after a certain amount of time. So that's where you can get, and you also do what we call laddering. Sometimes we'll have, and basically it's like bundling together a 10, 20, and 30-year term plan. So you have most of the insurance on that 10-year portion, and then the 20, and then the 30-year term will be the one that's less because, hey, after 20 years, most of your kids are going to be out of the house. Maybe first the oldest one may be graduating college, depending on when you get the policy. But you still want to make sure there's some money there to, again, like those final expense issues. But you don't need to be paying that entire big amount for what the insurance that you got when you were in your 20s. You may not need that much money. You may have paid off your home. You may have, you're looking close to retirement, and you're not going to have. You don't have to replace income because that's the big part there is that life insurance a lot of times is designed to replace your income because you're no longer able to come home. Now, the other thing on it, talk about replacing your income. We always talk about disability insurance, but the other thing is life insurance doesn't have to just be death insurance, as some people say, where I'm worth more dead than I am alive. You've probably heard that saying. Life insurance has changed a lot in recent years, and a lot of plans have what they call accelerated death benefit or living benefits. and they will pay out for chronic care or for critical care or for, I had it right there, for if you're terminal, if you're, and you can draw out, say, 75% of the death benefit of your life insurance, and some I think maybe even up to 90%. So what you do is you take an advance on that life insurance to cover expenses while you're still living, or you can use it, it's paid out to you. So if it's, especially like somebody that's terminal, but they're still getting around okay, but it's just not going to, the doctors have said, we can make you comfortable, but we're not going to, or it's inoperable, whatever the reason, or you elect not to do chemotherapy, something like that for a cancer. Maybe you want to take, I always use the example, you want to take that bucket list trip. Maybe you want to take that cruise around the world while you're still feeling somewhat okay and not just feeling old like me. But you can use that money for things that you wouldn't have the money for. And then there's still, but it doesn't let you cash out 100% because it still will leave some there for those final expenses. So there still is a death benefit on that plan, but you use those living benefits for other things while you're still living. So that's one of the things. That's one of the beauties of some of the term life plans. And I also mentioned the whole life plans. You can take out a loan against the insurance because maybe you've had that whole life plan for 20 or 30 years and it's built up a pretty good cash value. You can take out a loan from that. You're paying yourself the loan, and when you pass, the death benefit will pay off what the portion of the loan, and then pay out the rest to your beneficiary. So that's one of the things. The other thing I realize I want to get to before I lose too much time, run out of time here, is long-term care and nursing homes and those kind of expenses. And I think on the latest figures, the costs in a nursing home is like $140,000 a year. Most assisted livings, if you're going to go stay there, you're looking at $4,000 to $6,000 a year for that, or you may need in-home care. I'm not a fan of traditional long-term care insurance, and most of the time, especially like I have said, when I'm doing Medicare, is when some people will ask me about long-term care insurance. When you're in your 60s, that's not the time to start shopping for long-term care. You should have got it when you're 40, would have been a much better time. So a lot of times people can get that set up through their employer plans and pay into those. But what I don't like about your traditional long-term care plans are they're kind of like that term life. They're a use it or lose it. If you never need long-term care services, all that money that you spent over the years has gone to the insurance company because then they were prepared to cover you, and they've covered other people that are filing their claims. So they're thankful that you're paying your premium so they can afford to pay out for those services. But if you pass away before needing long-term care, they don't pay anything, and you've just spent that money. Now, some of the plans also will be set up, if you're married, the surviving spouse is able to continue those benefits also. So, but even so, again, both of them, use it or lose it. If you have that, say, tied into a life insurance policy, you can have life insurance policies with a long-term care rider, and like those accelerated benefits I talked about, the living benefits, you can also, those plans you take the money out and cover your long-term care. And that's usually on a whole life or an index universal life, those permanent life plans. So you'll have that money in your older years, because your term life, if you got a 30-year term life when you're in your 20s, well, when you're in your 50s, that's going to be really expensive to keep that same level of cost on that term life. So that's why it's recommended to do something that with a whole life, that it's going to cost a lot, but that price is never going to go up. So whatever it was when you're 25, that's what the price is going to be when you're 75. But it's been building cash value, and you have money that you can use for your long-term care. But you also name a beneficiary. So if something happens and you do pass without using your long-term care benefits or using all of the long-term care benefits, there is still a death benefit that will go to your beneficiary. So your money is not just going down the tube paying for insurance that you never use. It is money that you can pass on to your heirs as your legacy. The other way to do that, and this is what my wife and I have done, is we have an annuity. When she retired, she had a 401k that needed to be rolled over. And so we got an annuity that basically has a multiplier if we end up using those benefits for long-term care. The other thing with that is we do have beneficiary, just like with life insurance, beneficiaries and contingent beneficiaries. So if we don't spend that money out of that annuity because we passed before we used it, it will go to our heirs. So those are some things that you can do with your finances to make sure that you didn't just spend money over all these years and not getting anything out of it. So I did want to cover those things. Like I said, life insurance is not everybody's favorite subject, but just to kind of get people thinking. I saw a sign the other day, and I've been meaning to get like a poster made and have it put in my office. And what it says is, it's my job to ask you about life insurance. Don't make it my job to tell your family that you didn't have any. So it just gets you thinking, because a lot of people, and they come to me for health insurance, they're coming for Medicare, and they're not thinking about life insurance, but that is something we can help with also. If we can help you with life insurance, you don't have to be Medicare age. You can be 19. Come see me. I can get you some life insurance. And I don't care if you're 80. Come see me. I probably can get you some life insurance. It could be more expensive than that 19-year-old, but we'll get you something. So until next week, stay tuned to Insurance Matchmaking. You can always go to insurancematchmaking.com to leave show suggestions. But I always want to remind you, Matt Libby Insurance, we can cover you from head to toe, and it doesn't have to cost you an arm and a leg. And until we'll talk next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.